59,932. That's not a prediction. That's today, December 6, 2025. Silver just broke every record in its entire history. But while everyone's celebrating, I'm looking at something else entirely. 169 million ounces. That's what JPMorgan just moved into their vaults according to industry sources. That's roughly 9% of the entire global supply. They've been doing this quietly for 14 years. So here's my question. If silver doesn't matter like the experts keep telling us, why is America's most powerful bank hoarding this metal like it's the last lifeboat on the Titanic? I'm about to show you a pattern. A pattern that's appeared before every major financial collapse in modern history. A pattern that has never failed, and right now, we might be watching the final stage complete in real time. Disclaimer. Before we go further, I'm not a financial advisor. This isn't financial advice. I'm not affiliated with anyone mentioned here. This is purely educational analysis based on publicly available data. What you do with this information is entirely your decision. Now let's dive in. The four-stage pattern. I've spent months studying historical financial collapses. The South Sea Bubble, the 1929 crash, the Hunt Brothers, 2008, Lehman, all of them. And here's what keeps me up at night. They all follow the same four-stage pattern. Every single one. In silver, it's in stage 4 right now. Stage 1 is what I call the setup. Authorities create the illusion of stability. Prices get suppressed. The market floods with paper promises that look just as good as the real thing. Everyone trusts the system. Everyone's comfortable. For silver, this started in 1980 after the Hunt brothers nearly broke the market. Regulators panicked about volatility, so they built something massive. A paper market that analysts estimate is roughly 50 times larger than the physical market. Think about that number, 10 to 1. According to published COMEX data, open interest currently sits at approximately 244% of vaulted silver. Let me make this crystal clear. If just half the paper holders demand actual delivery, the system faces serious stress. That's not speculation, that's just math. Stage 2 is expansion. The gap between paper promises and physical reality widens. Debt explodes. Money gets printed. Promises stacked on promises. But prices, still suppressed. We've been living in stage 2 since 2008. Global central banks reportedly printed over $30 trillion. The US alone added around $8 trillion to its balance sheet. But silver didn't explode. Why? My analysis. Every time physical demand increased, major banks flooded the market with paper contracts. Short positions, derivatives. Market data shows prices stayed pinned below $30 for nearly a decade. Meanwhile, something fascinating was happening underground. Industrial demand was exploding. Solar panels need silver coating for conductivity. Electric vehicles require roughly 3 times more silver than traditional cars. 5G infrastructure.ai data centers. Medical devices. Industry reports now show silver demand from industry represents approximately 59% of total consumption, up from around 40% just 10 years ago. But here's the problem. Mine production hasn't kept pace. Data shows supply has declined roughly 7% since 2016. We're facing what analysts call a structural deficit. More silver consumed than mined for approximately 7 consecutive years. So where's the difference coming from? Stockpiles, vaults. Reserves, they're being drained. India's silver imports hit record highs. China's been purchasing consistently, but paper prices stayed suppressed until recently. Now here's where it gets really interesting. According to various market reports, since approximately April 2011, JPMorgan has accumulated what some analysts estimate at 675 million ounces of physical silver. If accurate, that could represent roughly 45% of the world's above-ground supply in 1,000-ounce bars. That's more than the Hunt brothers held at their peak, more than Berkshire Hathaway ever held, more than entire nations. Why would they do this? Here's what I found. In 2010, JPMorgan reportedly settled manipulation charges for around $200 million. When they acquired Bear Stearns in 2008, they inherited massive short positions. For years, they were on the wrong side of the trade. So what did they do? They flipped, covered their shorts, went long, massively long. Recent COMEX data suggests they're now sitting on approximately 169 million ounces in COMEX vaults alone, reportedly around 40% of total COMEX inventories. The gap between paper and physical has never been wider. Stage 3 is what I call the break. Something fails, could be technical, could be political. Suddenly everyone wants the real thing, the physical asset, not the paper promise. And there isn't enough. I think we're watching stage 3 unfold right now. Let me show you what I mean. November 28, 2025. The CME Group, the exchange handling derivatives, reportedly went down for over 10 hours due to what they described as a server cooling issue. During that outage, silver spiked to approximately $56.72 per ounce, an all-time high at that moment. When systems came back online, market observers noted bid-ask spreads were over $1. That's what illiquidity looks like. That's what chaos looks like. That's what happens when a paper market faces stress. Then, just days later, something caught my attention. According to COMEX filings, JPMorgan reclassified around 134 million ounces from registered to eligible status. Let me explain why this matters. Registered silver is available for delivery against futures contracts. Eligible silver is just stored there. It's not available for delivery. Think about the timing. JPMorgan reportedly pulled roughly 9% of deliverable silver off the table during peak physical demand. October 2025, market reports showed silver lease rates hit approximately 30% annualized. That means people were so desperate for physical silver, they'd pay around 30% interest just to borrow it. That's not normal. That's what a squeeze looks like. December 6, 2025, today. Silver hits $59.32. Reports suggest this is approximately a 98% gain year to date, the strongest annual performance since 1980. Stage 4 is what I call eruption. Price explodes, shorts get crushed. Institutions positioned early win big. Everyone else scrambling. This is where I believe we are right now. And this is where history becomes absolutely crucial. Let me tell you about Texas, 1979. Two billionaire brothers, Nelson and William Hunt. They looked at silver trading around $6 per ounce and saw something others missed. Inflation. Consumption exceeding production. A perfect storm. So they bought approximately 200 million ounces, around 1/3 of America's entire silver supply at the time. Then January 1980 arrived. According to historical records, silver hit $49.45. That's roughly 800% in just 18 months. Banks panicked. COMEX changed the rules overnight. Banned new long positions. Forced liquidation only silver Thursday. March 27, 1980 crash. The Hunts were destroyed. But here's what matters most. The squeeze was real. The shortage was real. And the 49er price was real. It literally took changing the entire game to stop it. Now imagine something with me. What if the buyers weren't two reckless billionaires? What if it was the bank that helps make the rules? That might be what's happening right now. 2008 taught us the same lesson. Paper mortgage securities collapsed when everyone wanted real assets simultaneously. Historical data shows gold was trading around $720 per ounce in October 2008. By September 2011, it reportedly hit $1923, approximately 167% surge. Why? When paper promises fail, money flows to physical reality. Gold, silver, real assets. But here's what concerns me about 2008. The central banks didn't fix the underlying problem. They just made it bigger. They printed around 16 trillion globally, bought their own debt, suppressed interest rates to zero, expanded paper markets even further. Which brings us to today. Silver is consolidating just below $60 right now. But let's talk about what could happen if it breaks through. According to reports, JPMorgan's earlier projection suggested around $38 by late 2025. We're already roughly $21 above that. Citibank analysts reportedly called for $36 to $39. Those targets have been exceeded. Some independent analysts have mentioned targets of $75 to $90 by end of 2026. But those are conservative numbers. Those assume the paper market holds together. What if it doesn't? Remember the Hunt brothers? Silver hit around $49 in 1980. When you adjust for inflation, that's approximately $170 in today's dollars. We're currently at $59. But consider this. The supply deficit appears worse now. Industrial demand is higher now. The paper market is exponentially larger now. Historically, silver has tracked gold at a ratio of around 15 to 1. Recent market data shows it's currently closer to 72 to 1. When that corrects, and historically it always does eventually, some analysts suggest we could be looking at $280 per ounce based purely on ratio reversion. I'm not saying that's guaranteed. But we don't need conspiracy theories. We just need what economists call mean reversion, and mean reversion tends to happen eventually. But here's the scenario that keeps me up at night. What happens when holders of paper silver contracts demand physical delivery? What happens when they realize there might not be enough metal to cover all the claims? What happens when pension funds, sovereign wealth funds, and retail investors all try to get physical silver simultaneously? That's the question nobody wants to answer. December 9th and 10th, 2025, 3 days from now. The Federal Reserve meets to decide on interest rates. According to Bloomberg data, current probability of a rate cut sits at approximately 87.2%. Here's my thinking. If they cut rates, the dollar typically weakens. When the dollar weakens, historically, gold and silver tend to surge. Gold is currently trading around $4,212 per ounce. Some analysts project $4,500 to $5,000 by mid-2026. Silver typically follows gold. It always has historically. But silver tends to move faster, more volatile, more explosive. In my view, the Fed meeting could be the spark. The structural deficit is the tinder. JPMorgan's positioning might be the accelerant. A paper market under stress could be the explosion. All the pieces appear to be in place. Physical silver is still available right now. Premiums are rising according to dealer reports. Some dealers mention delays, but you can still get it. That window might not last. When the paper market faces stress, when futures contracts potentially can't be delivered, premiums could explode. We're talking possibly 30%, 40%, 50% over spot price, maybe more. Look at what happened during the 2020 COVID panic. Silver hit around $28 per ounce, but physical coins were reportedly selling for $45. That's approximately a 60% premium. Now imagine that scenario with silver at $100 per ounce. I'm not saying this happens tomorrow, but it's probably not 10 years away either. The Fed meets in 3 days. That's the first domino. Industrial demand keeps rising. That's constant pressure. COMEX inventories keep draining according to reports. That's the countdown clock. When registered silver at COMEX drops below 50 million ounces, and it's reportedly at 113 million right now, the system could face serious stress. At current drain rates, 6 to 12 months, maybe sooner if there's a rush. This isn't just about silver. Silver is the symptom. The dollar is the underlying issue. Since 1971, when Nixon closed the gold window, the dollar has been pure fiat, backed by confidence and economic strength, but not physical assets. After over 50 years of printing, 50 years of deficit spending, some economists argue inflation has been masked by methodological changes to CPI calculations. In my view, the bill might be coming due. Gold is at $4,200, silver is at $59. Energy prices keep surging. Institutional money is flowing into alternatives. The entire market seems to be sending the same signal. Paper currencies face long-term pressure. Scarcity matters. In my analysis, silver might be the most undervalued scarce asset right now. Undervalued relative to gold. Undervalued relative to its industrial importance. Undervalued relative to money supply growth. When the market corrects that undervaluation, if it does, the move could be significant. In 1980, silver peaked around $50. It took 45 years to break that record. 45 years of what some call suppression. 45 years of accumulation. Years of coiling. And now we're here, $59 and climbing. The Hunt brothers were early. They got crushed. But they were right about the fundamentals. Now imagine if they had been patient. Imagine if they had the backing of the entire system instead of fighting against it. That might be JPMorgan today. They learned from the Hunt brothers' mistakes. They're not going to squeeze too fast. They're not going to be reckless. They might just let the market do the work. And when silver hits $100, then $150, then $200, if it does, they'll be positioned perfectly. The signals are everywhere, record highs, structural deficits, bank accumulation, paper market stress, Fed meetings, geopolitical tensions, all happening at once. That's not coincidence, that's convergence. Stage 1, the setup, done. Stage 2, expansion and debasement. Done. Stage 3, the crisis. Happening now. Stage 4, the inevitable outcome, loading. You don't have to believe me, but you should study history. And history has a way of repeating. I'm not a financial advisor. I'm just someone who's been studying these patterns, watching these markets, trying to make sense of what's happening. The silver situation isn't coming, it's already here. The only question is whether you're positioned to understand what's unfolding, or whether you'll look back in 6 months wishing you'd paid attention. The choice is yours, but think carefully, because December 9th is 3 days away. If you want to follow along as this unfolds, hit subscribe. I'll be tracking developments and sharing my analysis in real time as we watch this situation develop. Do you think silver hits $100 in 2026? Drop your thoughts in the comments below. I'm genuinely curious what you all think. This might be one of the most important financial stories of 2025.